Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Welcome to 2022. ETF saw another record year of inflows in 2021. What's ahead for 2022? Let's talk to two of the country's top ETF watchers, Tom Lydon from ETF Trends, John Davi from Astoria Advisors. Tom, let me start with you. The big themes of 2021, we talked about it all last year. ESG, number one. Number two, thematic tech. And finally, the lack of a Bitcoin ETF. But you say these may give way to a different narrative in 2022 based on inflation protection. Now, why are you saying that, and what are you recommending?
Well, Bob, we've seen concerns among the advisor community for the past year, and there have been areas like gold, which hasn't done as well, but energy, agriculture, base metals, a lot of those inflation areas that hedge during these times have done quite well. Two of the biggest by Invesco were up over 40% so far this year, and that's without gold participating. Gold tends to be a second half player. So if we do see continued inflation and rising rates into 22, I think we're going to start to see gold kick in as well.
You know, John, talking to you, I noticed you have a similar call speaking to you in the last week. You say inflation themes will dominate, will be less focus on crypto and less focus on disruptive growth. Explain that for us.
Yeah, I just think, Bob, last year was a perfect storm. You had COVID lockdowns, you had supply chain bottlenecks. So it was a perfect year for inflation to rise. And, I just think that, there aren't enough tools out there that can provide, a one ticker solution for investors to kind of not only just protect. See, you said an interesting word. You said protect against inflation. We at Astoria Advisors think you should, look to embrace it and not only embrace it, but look to benefit. And that speaks to Tom's point, which is that things like cyclical stocks and pro-cyclical commodities like energy and base metals actually do well when inflation rises. So let's change the narrative away from protecting, but to benefit from inflation. Because when I turn on CNBC every day, all I hear is guests on your show talking about how inflation is structural and it's here to stay. So I think we have to discuss a different narrative for inflation.
I want to go back to the stock selection point, because this is the question I get the most from investors here. The mean reversion question, I call it. Growth, mostly technology, has outperformed everything since 2009, since the Fed got very aggressive with monetary policy. And particularly in the last 5 years, growth and tech primarily has outperformed. So the question now is it time for value stocks, the pharmaceuticals, the banks, the energy stocks to shine? Tom, your thoughts on tech in 2022?
Well, they've already started, Bob. VLUE was up almost as much as the S&P 500 in 21. And obviously, from a valuation standpoint, those stocks are on sale compared to the stocks in the S&P 500. And as we talked about earlier, the equal weight strategy in the S&P 500 did just as well as the cap weighted strategy. So the good thing is we're already starting to see more participation across all stocks. And then again, as you talk about the big swing that we saw in growth versus value in the last 10 years, the divergence that we've never really seen before, things do eventually get back to the mean. And if you do have a diversified portfolio with both growth and value, you should do well over time. I think some of the areas that we continue to be concerned about is small cap participation hasn't been as great. Developed markets, emerging markets, again, not as great. But from a valuation standpoint, they look really on sale compared to the S&P 500.
John, your thoughts on growth versus value? I mean, I know energy had a good year, but energy's 3%. What about growth versus value? And what about international stocks? They've also underperformed the United States over the last decade.
Yeah, I think, we talked about value when I was on the show back in June 2020. June 2021. And, it's, as you said on that show at the time, it's like an old school ideology. And, I think at the end of the day, what works is that after a recession, like what we had in 2020, what typically works is value, inflation-linked strategies, cyclicals, and that, we expect it to continue. I mean, the last 10 years, you've had this proliferation of tech and growth because interest rates have been in a secular decline, and tech companies, their value increases when you discount future cash flows. But as interest rates go up, I think tech stocks are going to be challenged. I started my career, Bob. Energy stocks are 25% of the S&P. Now they're 3%. You mentioned cryptocurrencies.
Yeah.
Energy stocks, the XLE, basically performed the same as Bitcoin last year. But Bitcoin has these massive, fluctuations and massive volatility. So what's interesting is that energy stocks actually outperform crypto on a risk-adjusted basis, and I think that's going to continue for the next year or two. I think you're going to see a lot more rotation into the value, inflation, cyclical trade.
Yeah, I would hope so. I'm an old school guy. I'm a Jack Bogle disciple myself, founder of Vanguard, have been a disciple for many years. And we all know, all three of us, that over long periods of time, historically, value has outperformed growth and small cap has outperformed big cap. But it's been a long wait. Those guys who are into that philosophy have had a tough 10 years, and particularly a tough 5 years. So there's a lot of people saying, okay, Bob, when? And it's a tough call to make. I certainly believe in mean reversion, as you guys probably do. I certainly believe it's time for them to outperform. And the fact that the S&P Energy is 3% of the S&P, as John says, is astonishing to me, given that Exxon was the biggest company in the United States 20 years ago, Exxon and General Electric. So I keep waiting for that to happen. But I have to say, other than the interest rate rise, there are compelling arguments for keeping in growth, other than the interest rate problem that's happened many times. I want to move on and talk a little bit about inflows. It was amazing to me that in a year dominated by ESG and thematic tech investing, most of the inflows were into plain vanilla ETFs. We had $900 billion in inflows. Tom, you and I talked about this. And most of it, I'm looking at the top 6 list here. It was all S&P 500 ETFs that dominate the market, or the triple Qs I see here. That's the NASDAQ 100. But that's pretty amazing. Just on an inflow basis, with all this talk about crypto, all this talk about, small thematic tech investing, most of the money went into, again, the index guys, won out. And Tom, will that continue into 2022? What would reverse that?
Well, not a lot, Bob. I mean, it's just another great reason what ETFs are all about. It's diversification, it's low cost, it's tax efficiency. The first S&P 500 ETF that was put on the map back in 1983, it continues to be for all the right reasons. As more and more investors have shifted away and almost lost confidence in active management, they understand that core investing and core diversification is key and critical. More and more advisors have models that are wrapped around these core indexes. And we're going to continue to see flows as we've seen money come out of active mutual funds at the rate that we've seen money going into ETFs. So it's all for the right reasons. It's really fun to talk about thematic strategies, crypto, gold, things like that. But when you look at where all the money's flowing, it's in those basic indexes and the ETFs around them.
Yeah, John, you've had a very simple approach to this for a number of years now. You've advised investors to keep 70, 80% of their portfolios in low-cost index funds and then take the rest and try to add alpha. You advise still using thematic tech. Is that balance still right? Take 70, 80%, put them in low-cost index funds, and take the rest and try to get some alpha? And where do you get alpha this year?
Well, I think that, that should still be the message. At the end of the day, actively managed mutual funds last year had $400 billion of outflows. So that big number you just mentioned, I look at that as being reduced because a lot of it is just people continually shifting out of active management to passive. And I think it's because active managers just don't take enough risk. They charge too much. But yeah, put 70-80% of your ETFs and tickers like, VTI, IEMG, IEFA, and then use like a sleeve of 15-20% in things that you believe in. So we at Store Advisors believe in inflation. So we've got, strategies, to kind of benefit from higher inflation. So I think your core should be cheap. You should hold it forever, and then on the margin, you change your sleeve periodically, depending on what are the latest trends in the marketplace.
I want to move on and talk about bond funds because it was quite amazing to me. Bond funds also had, for the most part, modest inflows, but they were all down for the year. Most of them were down about 1%. I mean, not a lot, but is there anything in the bond ETF universe, Tom, that you're looking at? John, you could take a crack at this too, but is there any reason for us to look at it? What about high yield? I internally get questions about high yield. People are throwing money still at high yield at 3.5% to 4%. Is that too risky now?
Well, I think this is going to be the big story in 22, Bob. Most don't remember what it's like to invest in fixed income during rising interest rates. It's just not good for a fixed income portfolio. We're surveying advisors all the time that are moving their 60-40 strategies to 70-30s or even 80-20. So what's happening is money is leaving the Barclays Ag core strategy and either doing one of two things: going over to the equity side and looking for dividend strategies, or they're going to real short duration active ETF strategies, or in fact cash. We've got a record $7 trillion in money market funds, $15 trillion sitting in passbook accounts at banks. It's scary because people are concerned about what rising rates do. One final thing, on the other side of the barbell, they're looking at options overlay strategies. We've talked about strategies like Nationwide Newsy or JEPI out by JEPI out by JP Morgan. It's a great way to get added incomes, in some cases 7 or 8%, while you're also have some exposure to equities. And I think we're going to see more of those types of strategies come to the surface.
Yeah, John, apropos of what Tom was saying, Vanguard's short-term bond fund was had some of the biggest inflows this year. It's kind of strange to see a short-term bond fund with enormous inflows, but that goes exactly to what Tom was telling us about. Now, John, last week you launched a new ETF to address these inflation issues we keep talking about. This is the Access ETF that you launched last week. Tell us a little bit about that, the Access Astoria Inflation Sensitive ETF.
Sure. So ticker is PPI. It's kind of a play on the producer price index, which is one of the biggest inflation groups there. Look, Bob, at the end of the day, going back a year and a half ago, I was on CNBC and I said, look, I think rates are rising, inflation's rising, and what we were doing in our portfolios is that we were buying things like banks, industrials, energy, commodities, some of the agricultural plays. And our core portfolio combined with our sleeve became a little bit, overwhelming. So we just thought, okay, if we're struggling with this, if we've got 7 ETFs that we're trying to use to cobble together an inflation theme, let's look at a potential ETF that provides, a one ticker solution that gives you broad market exposure to not only cyclical stocks, which benefit from rising inflation, but also physical commodities, commodity equities, and then tips. So that's what PPI does. It has those 4 segments, cyclicals, commodity equities, commodities, and tips. And I think, again, the narrative is, you said earlier in the show, protect, but we think you should embrace it and then look for strategies that benefit. So the ETF has, the 4 sectors are industrials, energy, materials, and banks. Those sectors historically have had the most sensitivity to rising inflation, and then along with those commodities and tips that I mentioned. So we're excited for it. I think next year will be the theme of inflation ETFs out there.
Yeah, and Tom, what do you think of this here? So what John's got here, 70-80% in cyclical stocks, 10 to 15% commodities, 5 to 10% in tips. I get a lot of questions about tips these days, but I just don't quite get it. I understand it's inflation protected, but it's not going to. It doesn't seem like tips is going to provide you much inflation protection if you really want to try to do a little bit better. I don't know how or what you're advising, but what do you think about tips? I see they're just a very tiny part of John's ETF here.
Well, there's a safety component there, and I think what John and his team has done is great because, first of all, there's a huge void of education on inflation and what it can do to client portfolios. And if you look at commodities in general, up until the last 12 months, it's kind of been an unloved area. So now, by being able to take those areas of the market that do well during times of inflation, I think to what John is saying, it doesn't have to be scary. You can actually lean into it, embrace it, and you can do that by picking off certain sectors in the market and adding it to your portfolio. John's done that with his clients and then said, hey, let's wrap all these areas up into one easy ticker. And then for those that don't have any type of inflation protection, they can buy that one ticker and make it really easy. Hey, I'm a big fan of the traditional fund of funds if it's allocated the right way. Here you've got a manager that's seasoned in spending a lot of time on the markets, and you get it all in one ticker. I think it's great.
Yeah, well, here's an actively managed, ETF in the inflation space. I think it's terrific. By the way, the Access Management team has an old friend of ours, Tom, Ben Fulton's on that, and an old friend from the Power Shares days. So we wish him well, of course. Always good to see a favorite old friend pop up again. I want to just talk about the two big stories for 2021 and what happened. China and Cathie Wood. Tom, is it safe to bet against either of these asset classes? I call Cathie Wood an asset class, but you got to admit, John made this point earlier, it's hard to find active managers that really make big bets. You can get kind of like passive active managers, but Cathie Wood makes big bets, and she blew up on the upside and she blew up on the downside. Let's just handicap China and Cathie Wood.
Yeah, well, first of all, Cathie Wood just didn't blow up on the upside last year. She's been at it for a while and has put up really, really good numbers. Her team has a long-term outlook. They haven't hidden the fact that their outlook is 5 to 7 years. And although many people came in the last 18 months, it's okay because, look, even though many folks are retiring in their 60s, they're going to live well into their 80s. I've talked about Cathie Wood and her lineup to younger people all the time. But listen, Bob, I'm going to be 62 this week, and I'm invested in Cathie Wood and will continue to be for the next 20 years because I know the future FANG stocks are going to come up in our portfolios. So you just have to ride it out, and if you're diversified, you're probably doing okay. Quickly on China, China's not going away. China's going to continue to be a big part of the global infrastructure, and we are clearly intermingling with China on a daily basis. I think China's a buying opportunity. There are a lot of companies like Crane Shares who do a great job. When you intermingle China and online buying, it's something that we're going to be talking about for the next 10 years.
First, happy birthday, Tom. Always a pleasure to be with you. You're a few years younger than me, and you look terrific. So you got a lot more time and a lot more time for you and I to interact together over the years. John, your comments on Cathie Wood and China. My thought on Cathie Wood is a lot of people say, she failed. I don't think Cathie Wood failed. I agree with Tom. I think Cathie Wood succeeded in convincing everybody about the powers of disruptive technology. The problem is everybody believed her. They bought in and drove the prices up to crazy levels. And at some point, somebody's going to start asking about valuation questions, particularly around certain companies that don't make any money or companies, that are flattish for the next few years in terms of earnings. It will matter, and that's what's happened. The people have started saying, we don't hate these stocks. We just want to know what the right price is, given the environment we're moving into in 2022. So give us your take on Cathie Wood and China.
No, I agree with a lot of what you guys said. I mean, at the end of the day, if you're trying to find the next FANG stocks, I mean, she's probably the most qualified out there. So look, I mean, she had 4 or 5 great years, 1 bad year. So I think that's okay. I think the market environment has kind of changed in terms of people are now starting to look at earnings and profitability a little bit more. I mean, at the end of the day, this is now the 3rd year of the COVID recovery. So we are now late cycle. Interest rates are rising. So I think that impacts, the future discounted cash flows for a lot of tech companies, and a lot of the ones that I think in our portfolio, they're not really profitable. But I think she's the best to kind of look at the next FANG stock. So, I've always said when it comes to, disruptive growth, Bitcoin, you got to size it appropriately in your portfolio. So it's got to be less than 5%. If it's less than 5%, then you can ride out these waves. For China, look, I've been on your show, Bob, many times talking about China. We liked it. We were overweight. it was a very difficult year last year for China. I don't think the billion people out there, I still think there's a way to monetize it. And, we've always told investors it's a long-term play. So again, we size it appropriately in our portfolio. So I think you got to stick with China in your portfolio as well.
I think the problem I have, my 2 cents on China, is there's two kinds of investors in China. One are the value guys who are floating around saying, all right, if it's 15 times forward earnings or less, we're interested, and we don't care about the politics. Historically, it's performed well when you get 15 times forward or below. And there's a sort of a knee-jerk kind of investment ideology or strategy, a value strategy. I think the broader problem is with the people who are in the global community who are trying to figure out, used to believe that you could have China as an investable play based on, say, market capitalization. And what's happened in the last year is people are now saying, wait a minute, the political risk factor around China is far, far higher than in other countries around the world. Therefore, do we need to completely relook the way we're investing in China because of the higher political risk factor? Or is it even, should we even consider investing in it given the particular ideology involved in the country? So there's an overlay here on China that didn't really even exist a year ago, and that's one of the things that I'm having trouble dealing with. Should we say, yes, we need to be compensated for the higher political risk component associated with it, or could you go even further and say, no, China's uninvestable at this point? Tom, do you get my point here, how this debate's changed in the last year?
You're right, Bob, but the key thing is China continues to grow. Their investable assets continue to grow. And with that, there's more demand from a global market cap standpoint. But to John's point, you have to allocate an appropriate amount. Listen, the U.S. and the rest of the world and China are always going to do saber rattling, and it's going to be part of the landscape going forward. So we have to know that. Does that mean you avoid it 100%? No. They're not going to shoot themselves in the foot. There's always going to be the back and forth, the ebb and flow, and that's something that's consistent with China over time. So you just have to factor that in and then have the appropriate allocation. If it has a run-up, pull back, give it that 5 or 10% allocation in equity portfolios that's appropriate. But, if you do overweight, you're going to live and die by the sword.
Yeah, it's a good point. All right, gentlemen, I'm going to have to leave it there. That does it for this first ETF Edge of 2022. My thanks to Tom and John. We've asked Tom to stick around and give us a little more perspective on 2022 trends for our ETF Edge podcast coming up. And remember, you can see all of our videos on our website, etfedge.cnbc.com. Everybody, have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.